All right, we need to talk about some of the wild economic news that's been hitting the headlines. We've got a government shutdown, a pretty awful jobs report, but what in the world does any of that have to do with your mortgage rate? Well, let's break it all down.
So here it is, the central question, the big paradox we're tackling today. How on earth can really bad news for the economy, we're talking a government shutdown and a dismal jobs report, actually lead to good news for mortgage rates? It sounds completely backwards, I know, but we're going to connect the dots.
Okay, so to really get what's happening with rates, you first have to understand the two major economic events that are shaking everything up right now. It's really a one-two punch to the economy.
So the first piece of bad news dropped with the ADP jobs report. Now, the folks who watch this stuff, the analysts, they were expecting a gain of over 50,000 jobs, but instead, the economy actually lost 32,000. That is a huge, huge miss, and it basically sent a signal flare to investors that, hey, the economy is cooling down and maybe fast.
Yeah, that number right there, negative 32,000. That really jolted the market. You know, it's a key piece of data the Federal Reserve watches, and it immediately got everybody thinking, okay, what is the Fed going to be forced to do now?
So with all this economic chaos, you'd think interest rates would be shooting up, right? But the market did something kind of surprising. It led to what Wall Street calls a flight to safety.
Okay, now to understand this flight to safety thing, we need to geek out for just a second on something called a mortgage-backed security, or MBS. Just think of it like a big bundle of home loans all packaged together and traded around on Wall Street. The price of these things moves every single day, and it's a massive factor in setting the actual mortgage rate that you pay.
And the relationship between the price of these mortgage bonds and the interest rate you get is, well, it's inverse. Honestly, the simplest way to picture it is a seesaw. When one side goes up, the other side has to come down.
So when investors get nervous, about things like a government shutdown or a bad jobs report, they start looking for safer places to park their money. They sell off riskier stuff like stocks, and they buy up things they see as safe, like these mortgage bonds. And that sudden rush of demand, it pushes the price of those bonds up.
And remember our seesaw? As the price for those bonds goes up, the other side of the seesaw, the interest rate, comes down. Why? Well, the yield, which is just the return an investor gets, has to adjust. So higher bond prices mean lower yields, and those lower yields translate directly into lower mortgage rates for you, the borrower. So, after all that, what does this actually mean for you if you're out there house hunting or thinking about a refinance? Well, this whole weird market reaction is creating a potential silver lining in all this economic uncertainty.
I mean, just look at this. Because of all this weak data, the market is now almost completely certain that the Fed will have to cut its benchmark interest rates at its very next meeting. We're talking a 99% probability. That is a massive shift from just a few weeks ago.
And we're already seeing the ripple effects. The 10-year Treasury yield, which is kind of the benchmark that mortgage rates tend to follow, has already dropped to its lowest point in weeks. It's happening right now. Bad economic news is translating into lower borrowing costs.
But, and this is a huge but, before you run out and try to lock in a lower rate, there's a major catch. The government shutdown itself is creating a serious, real-world logjam for a huge number of homebuyers.
Get this, a full third of all recent mortgage applications are for government-backed loans. We're talking FHA, VA, and USDA loans. And with parts of the government shut down, these are the exact programs that are now facing major delays. And here's what that actually looks like. If you were hoping to get a USDA loan for a home in a rural area, you're pretty much out of luck for now. New loan issuance is completely on hold. And for really popular loans like FHA and VA, you can expect some serious delays because they're working with skeleton crews. And if that wasn't enough, there's another roadblock. The National Flood Insurance Program has stopped issuing new policies. Now, if the home you're buying is in a designated flood zone, you cannot close your mortgage without this insurance. It's estimated this one issue could hold up over 1,000 home sales every single day this shutdown goes on.
This whole situation is just a perfect example of that old saying, all real estate is local. The national headlines, they don't tell the full story. What's happening in your city could be completely different from what you're hearing on the news.
For example, let's take a look. The national average home price has now crept past $400,000. But then you look at a city like Greensboro, North Carolina, and the average is way down at $373,000. That is a huge difference, and buyers are definitely noticing.
And it's not just about the price of the house. You've also got lower taxes drawing people in, which is why states like North Carolina are seeing this massive influx of new residents, especially from more expensive states. It's actually on track to become the #2 destination in the entire country for people who are relocating. So this leaves us with one final big question. Could this national economic turmoil actually create a real buying opportunity in your local market? I think the big takeaway here is that while the national news can feel pretty chaotic, the same forces creating all this uncertainty might also be creating a window to lock in a lower mortgage rate. It's a powerful reminder that in real estate, sometimes what's happening on your street matters a whole lot more than what's happening on Wall Street.